Welcome to Talk Tickers, the show dedicated to extracting the crucial shifts and surprising dynamics hidden beneath the financial headlines.
Today we're doing a deep dive into, well, one of the most explosive growth areas in modern finance.
Evergreen private market funds.
Exactly. These are hybrid investment vehicles, and they promise what really sounds like the Holy Grail: access to high-returning, illiquid private assets, but with the convenience of periodic liquidity.
So we've sifted through the structures, the performance reports, all the fine print.
And our mission today is really to cut through the marketing noise and uncover the inherent structural risks, specifically around liquidity, and I think most critically, asset valuation.
Okay, let's unpack this enormous shift. The scale of growth here is frankly astonishing, especially when you look at private equity evergreens.
It's massive.
Just to give you the context, by the end of 2024, the total U.S. evergreen assets under management AUM had just ballooned to approximately $380 billion.
And of that, about $70 billion is focused specifically on private equity strategies.
And that $70 billion, that's just the tip of the spear, isn't it?
It is. If we zoom in on the biggest players like the 16 largest SEC-registered PE evergreen funds, the growth ramp-up is almost vertical.
What are the numbers there?
They scaled from just $10 billion in AUM in March 2021 to a staggering $61 billion by March 2025. You're just seeing a floodgate of capital opening up.
So if you're an investor, what's driving this flow? It's simple, right? It's that promise of flexibility.
It absolutely is. I mean, investors are drawn by liquidity management and time flexibility. They want access to private markets without locking up capital for a rigid, decade-long term.
They want in, but they also want a potential way out.
A way out, exactly. They want to be able to subscribe and potentially exit over the lifetime of the fund. That's the stated benefit.
But here's where it gets really interesting, and where the paradox lies. We're seeing funds launch since 2020, reporting annualized net returns often in the high teens, sometimes above 20%.
And they're doing this while also claiming unusually low volatility, often below 7% annually.
In what has been a historically volatile period for private markets, that kind of stable high return, it demands some serious scrutiny.
It does. It raises the immediate question: what exactly is this structure? And how is it seemingly immune to all the market turbulence we've been seeing?
So let's start with the basics. What exactly is an evergreen fund? We hear the term, but it often feels intentionally vague.
Fundamentally, they are hybrid vehicles. The easiest way to think of them is blending the subscription model of an open-ended fund, like a mutual fund where you can come and go, with the illiquid assets of a closed-ended fund, like a standard private equity drawdown fund. The key difference is there is no fixed maturity date. The fund just, operates in perpetuity.
And the structure really took off after 2021. What were the market catalysts that created the perfect storm for this product?
The primary catalyst was a massive liquidity crunch following the post-COVID inflation shock. Institutional investors, the limited partners or LPs, found themselves massively overallocated to private equity.
You mean the denominator effect? Their public stocks fell, so their private holdings suddenly looked like a much bigger piece of the pie?
Precisely. So they needed to sell, but the traditional exit routes were completely frozen. IPOs dried up, and strategic sales slowed to a trickle.
So you've got this huge pressure on LPs who need cash to rebalance.
At the exact same time, regulators were widening the access door. We saw the accredited investor definition expand in the US and reforms like LTIF 2.0 in the EU. It all made it easier for high net worth and even retail investors to step into these historically exclusive assets.
So new money was ready to meet the institutional need for an exit.
Yes. And that liquidity shortage for LPs triggered a seismic shift toward the secondary market. Evergreens essentially stepped in to be the buyers of last resort.
That's a critical point. As traditional exits failed, the need for liquidity was satisfied by secondaries.
That's right. Evergreens became incredibly active participants in this space. I mean, some projections suggest that as much as 60% of the capital Evergreens raise in 2025 will be deployed into secondaries.
Buying portfolios from other LPs or taking over assets from GPs in continuation funds?
Both, LP-led and GP. And this leads us to the critical benefit for the managers themselves, the general partners or GPs. This structure gives them the most precious thing in finance:
perpetual capital.
Perpetual capital. It's fascinating because it entirely changes the GP's business model. It provides a strategic source of permanent capital, which generates stable, recurring fee income.
And if you're a publicly traded alternative asset manager, Wall Street loves that predictable revenue.
Of course. It offsets the lumpiness of traditional 10-year drawdown funds. They are transforming an episodic fee structure into a subscription-like revenue stream.
Okay, that's the management benefit. But let's flip the coin and look at this from the investor's perspective. You put your money in expecting liquidity, but what's the reality in the fine print?
The reality is that the promise is extremely conditional. The typical redemption policy offers 5% quarterly tenders, which sounds like 20% annually.
Sounds pretty good.
It does. But in the fine print, especially for tender offer funds, this is often not an obligation, it's a capacity. And it's almost always restricted by lockup periods and fund level gates that can slam shut if redemption demand is too high.
So if the underlying assets are illiquid, meaning they aren't generating cash through sales, where does the cash for these redemptions actually come from?
That is the core structural friction point. Evergreen distribution rates, the actual cash generated from underlying asset sales or exits, have frequently fallen well below that 20% needed to support quarterly redemptions.
Which forces the funds to do what?
To rely heavily on new capital inflows, on new subscriptions, just to pay off the exiting investors.
Wait, let me make sure I understand that. If the underlying business isn't throwing off enough cash to cover the 20% promised liquidity, you are literally relying on new investors joining the fund just to pay the people who want to leave.
That is exactly the dynamic. Think of it less like a standard fund and more like a club that relies on constantly finding new members just to refund the initiation fees of the people who are leaving.
Wow.
The moment that line of new subscribers shrinks, the liquidity promise can collapse instantly because the cash isn't coming from asset realization.
Do we have a real-world example of this pressure? Because that sounds like an acute risk.
We absolutely do. If you look at the cash flow dynamics of CPG Carlyle, for their fiscal year ending 2025, new subscriptions were a mere $4 million.
$4 million, okay.
While redemptions hit $162 million.
$4 million, okay.
That fund was forced to rely almost entirely on distributions from its existing underlying assets or potentially on forced, suboptimal asset sales just to honor that $162 million in requests.
And it's not just current cash flow pressure. When they buy these secondaries, they are acquiring portfolios that come with future obligations. That's a hidden leverage component, isn't it?
It is. It's huge. When evergreens acquire secondary portfolios, they inherit substantial unfunded commitments. These are future capital calls that they are legally obliged to fund.
More cash they have to come up with later.
Exactly. It adds significant hidden liquidity pressure. For instance, CPG Carlyle had $329 million in unfunded commitments versus a total net asset value, or NAV, of $880 million. That's a massive forward obligation.
Which brings us directly back to those paradoxical high returns and low volatility we talked about. If the market is struggling and liquidity is strained, how are these funds reporting 18% to 20% returns? This sounds like we're entering the valuation illusion.
We are. The valuation illusion is central to the evergreen appeal. The reason returns look so stable and high is that the vast majority of recent performance, for newer funds it's often over 90%, is driven by unrealized gains, paper profits.
And this is tied specifically to that secondary strategy and a quirk in accounting. Tell us about this one-day gain.
It's powerful, and it's surprisingly simple. When an evergreen fund buys a portfolio of assets on the secondary market, say, for a 30% discount to what the original manager currently values them at,
okay,
the fund immediately writes those assets up to the original general partner's reported net asset value. This is an accounting shortcut, using the existing valuation as a practical expedient.
So they buy the asset cheap, and the moment they own it, they value it at the higher pre-existing price.
Exactly. They are, in effect, taking the seller's homework, the previous higher valuation, and using it as their own. This creates an instant, massive, unrealized paper profit the moment the transaction closes, which immediately boosts the reported performance.
Let's look at the Carlyle AlpInvest case study to see just how material this impact is. This is where it gets truly shocking.
Yeah, this really puts a fine point on it. In fiscal year 2025, Carlyle AlpInvest reported a net return of 18.69%. Pretty great.
Very good.
But when external analysis was conducted to remove the impact of those in-quarter markups on new secondary purchases, to remove those one-day gains, the fund's net return dropped dramatically.
To what?
To 7.45%.
Wait a minute. More than half, over 11 percentage points of the reported net return just evaporated when you pulled back that accounting curtain?
Gone. They're essentially generating alpha just by purchasing the asset and marking it up on day one.
That's an incredible accounting feat, not necessarily an investment management skill.
That is the structural misalignment.
Yeah.
And the market knows this illusion exists. I mean, if you connect this to the broader picture, you see LSE-listed private equity investment trusts, which hold very similar assets, consistently trade at huge discounts to their NAV.
Often around 30%?
Right. Which suggests a wide, persistent gap between the stated value the Evergreen fund uses and what the assets would actually clear for on an open market.
Okay, we have to talk about the cost of all this flexibility and stable returns. The fee structure here is notoriously burdensome.
It is. Total all-in annual fees, when you account for everything, can often exceed 500 basis points. That's 5% a year. But the real problem isn't just the high cost, it's the incentive structure. It's tied directly back to that valuation illusion we just discussed.
You're saying the managers get paid on the paper profits?
That's a core conflict. Incentive fees are frequently assessed on unrealized NAV growth, and crucially, they lack traditional clawback provisions.
So there's no way for investors to get that money back if the valuations later prove to be wrong.
Pretty much. Look again at Carlyle AlpInvest. The advisor earned $23.9 million in incentive fees in FY 2025. That was underpinned by $243 million in unrealized gains. And here's the kicker.
Okay.
The total realized gains since the fund's inception, so all the actual cash profits ever generated, only amounted to $13 million.
So the manager was paid nearly double the amount of all cash profits the fund has ever made in its entire lifetime, just based on accounting marks.
Yes. That structure incentivizes the manager to value assets aggressively and keep them on the books, rather than selling them successfully. It rewards accounting performance, not successful exits.
A fundamental misalignment of interest with the long-term investor.
Absolutely.
So finally, let's consider the governance implications and the systemic risk here.
Well, evergreens are increasingly seen by some analysts as a late cycle mechanism. They provide this giant uncapped vehicle to warehouse-aged illiquid assets, effectively delaying true price discovery across the entire private market ecosystem.
And because they're uncapped in size, they can dilute protections that institutional LPs normally negotiate.
Like concentration limits and things like that, yes.
It's a complicated picture. Innovation providing retail access to high-demand assets, but with structural risks that are hidden right below those glossy performance numbers.
Which leads us to our signature segment, host speaker and expert speaker. The one question.
How much of the latest reported performance relies on incentive fees paid on unrealized gains from assets acquired at a discount?
And this matters because when you reward managers for accounting markups rather than for successful realized exits, you create a structural misalignment that incentivizes aggressive valuation and masks true asset volatility and liquidity risk.
It keeps the asset bubble inflating.
Potentially, yes.
So to recap, Evergreen funds clearly offer enhanced access and flexibility. They are meeting a massive investor demand for semi-liquid private asset exposure. But you, as the investor, have to perform heightened due diligence on three fronts.
First, you must scrutinize the viability of the liquidity mechanism. Do not assume you can redeem 20% annually. Second, investigate the true source of performance.
Separate the real from the paper.
Yes, separate realized gains from unrealized accounting gains. And third, absolutely understand the high and often misaligned fee load.
Our goal today was simply to impartially convey the structural dynamics of these vehicles based on industry analysis so you can make a more informed decision.
We invite you to reach out with follow-up questions or data requests for future deep dives.
And here's something to think about. What happens if that public market discount to NAV we see in those LSE trusts starts to infect the private market valuations these funds rely on?
That's a good question. From all of us at Talk Tickers, we'll catch you on the next call.